Hello, everyone. Welcome to our first search and matching seminar in this semester. Today, we're very happy to have Micheal Lee as our speakers, and we would like to express our special thanks to the panelists who can join us today. And as a reminder, the format is 1 hour with presentation, and then we do have 15 minutes Q&A. And then our upcoming seminar is second Monday of the month. So we are going to have our seminar monthly at each month at the second Monday of the month. And next speaker is Matthew. Okay, so without further ado, we're going to pass the floor to Micheal.
All right, can everyone see my screen?
Yes, you're great.
All right, well, thank you so much for this opportunity to present in the seminar. This is joint work with Rod Garrett at UCSB and Antoine Martin, who's here with us today, and Rob Townsend. And I'll start with kind of the usual disclaimer: the views expressed are ours and not necessarily that of the New York Fed or the Federal Reserve System. So this paper thinks about the potential for information disclosures to impact OTC markets, and in particular, dealer intermediate markets. So let me start by kind of setting the background for what motivates this paper. So as many of you know, a large volume of financial trade occurs in decentralized markets. And a kind of common feature that we've observed and studied a long time is this, what we call a tiered trading structure. So in these tiered trading structure, we have dealers who typically make markets on behalf of their clients, and this can typically be peripheral dealers or other traders. And they also then trade with each other very actively in interdealer markets. Now, this active trading in interdealer markets is primarily to reduce liquidity costs. So by entering offsetting trades, dealers can reduce their net positions. It also lowers the liquidity costs associated with making markets. And in this way, interdealer markets play a really vital role in terms of allowing dealers to provide liquidity to their clients. Now, having said that, a prime feature of these OTC markets is also the opacity. And in particular, what complicates these kind of gains from trade in interdealer markets is the fact that all of these dealers become differentially and asymmetrically informed through their market making activity. So in their respective markets or segments, they make markets, they learn about kind of the fundamentals through their trading activity. They turn around and they meet each other. And while there can be gains from liquidity, they also are concerned about this information. Now, in contrast, we have seen over the last decade and more so centralization in post-trade processing. So post-trade processes are now typically centralized, and you can think there are various different types of entities that provide centralized services. So we have clearing platforms, we have trade repositories, and even trading platforms all together providing a very centralized service on behalf of OTC markets. So decentralized entities perform post-trade activities, and in the process, they're able to access and control information that's particularly valuable for dealers. Now, a very basic and important example is trading data. So when individual dealers are making markets, they submit these types of trading data to these central platforms for other post-trade reasons. Well, this can be aggregated by platforms, and this forms the basis for a lot of market level information that can be vital to dealers in their actual trading activity as well. So the main question of this paper is to think about how the availability of post-trade information affects market liquidity and efficiency in these OTC markets where we have dealers intermediating liquidity for clients and also trading with each other. And actually the key question or next question on top of this is to also consider the strategic sale of post-trade information by private platforms. Now, in order to kind of answer this question,
Micheal, can I just ask a quick question? It's Ben. Just a quick question before we go there. So, I mean, I guess there are lots of difference between these sort of more centralized platforms and the decentralized one. Some have to do with just timing and frictions. Other have to do with clearing. So you guys are focusing on just post-trade price transparency. So like, I guess what I'm asking is if everybody at a OTC market just reported their trade immediately, would that be a lot different in the way you're going to think about it from a centralized market?
So in fact, we're going to think about an environment where some kind of platform receives or gets these reported trades and is choosing how to disclose this information back to the dealers. So in that sense, yes, the trades are all reported. The question is, how is this going to be disclosed to the public, in particular to the dealers who now can potentially use this information in their future trades as well?
All right, thanks.
So we are abstracting away from the various different types of post-trade services that these platforms might provide, and instead focusing primarily on the informational dimension. So in order to do this, we develop a model of OTC markets, in particular with the feature of this tiered trading structure. And in particular, what we're interested in is to allow for these dealers to endogenously acquire information through their respective market-making activity. Now, on top of that, we want to study the impact of post-trade information disclosure, and we want to consider this kind of interaction between the information acquisition motives of the individual dealers and also how this disclosure environment may affect that as well. Now, the final and kind of ultimate question we want to consider is what happens when we have a strategic platform that endogenously chooses this disclosure environment. What would they want? How would they kind of try to, what kind of information environment would they want to induce? So in today's talk, I'm going to first go through the baseline model and kind of show you how we have a model where there's a feedback between the market liquidity or the liquidity provision of dealers to clients, and also the interdealer market liquidity, the liquidity when dealers are trading with each other. Now, on top of that, we're going to first consider exogenous post-trade information disclosure. And we're going to take as given an exogenous policy or availability of information disclosure. And what we find is a fairly intuitive result. With full disclosure, there are improvements in market liquidity. So when everyone is able to equally access this information, there are clear benefits to disclosure. However, we generalize the environment to consider limited disclosure when there's a limited rollout, when only a subset of the dealers can obtain that information or process that information in time. And we can show that it can actually worsen liquidity relative to no disclosure. Now, these kind of exogenous results kind of set the tone for considering what the strategic platform will do. We see that with limited disclosure, information can actually be harmful rather than positive.
Sorry, Michael, before you go to this point, so can you say again what you mean by limited disclosure? Is it like I only release some information to everyone, or I release the information to only some dealers?
It's going to be the latter. Only a subset of the dealers may be able to access this information.
Okay, I'm just curious. I mean, maybe that's too early to ask this, but in practice, like, would it even be legal to disclose information to only a fraction of participants?
In this particular case, and I will motivate this when we get there as well, what we have in mind is potentially the fact that dealers may not all be able to process the information in time when they enter the second stage of trading, or there can be selective disclosure. Now, when it's exogenous, we're going to assume that as given. In the strategic case, in fact, it's going to be endogenously determined by whether dealers opt to acquire this information or not, or pay for this information.
Okay, thanks.
Yeah.
Can you follow up on that, what Vincent and also Ben asked? So let's think about like let's say corporate bond market. So I don't know what asset you have in mind. Let's think about corporate bond market. Legally, you have to report, the dealer has to report within 15 minutes to FINRA, and there's certain things that they have to report. Let's say the price, the size, and etc., the counterparty information. So what do you have in mind here? So what is the discretion from the dealer side in terms of acquisition or reporting? Can you maybe clarify this? Maybe it's coming later. That would be great.
Yes, exactly. So now in corporate bond markets and with TRACE, like we have this kind of regular disclosure of these trades that are actively occurring. And the question is, once this data is potentially aggregated, for example, by a platform who's now kind of releasing market data, will you want to acquire, will you, for example, pay a cost to acquire this market data that processes this aggregated information? So in certain markets, there is disclosure of these trades. In other markets, they're not yet. And what happens to this data? Are you able to access the data in a timely fashion? These are kind of the features that we're thinking about.
So for example, for the corporate bond market, the data is available. It's accessible for everyone. It's out there in trace. So what you have in mind is like potentially some other market that the dissemination of information is not actually as prevalent as the corporate bond market, something like that, right? Is that the way to think about it?
So in regards to the corporate bond market, the way that I view it is the question of whether all dealers are able to process that information in time for future trades. So it may be accessible, whether these submitted trades are always being processed by these dealers and incorporated into their trading activity is the question. And so I think that our results on limited disclosure will speak to that. Now, there are other markets where this data may not be available. And to that, it's more of a direct interpretation of, well, it's really not available.
Thanks.
Yeah.
So it seems to me that even if the data is relatively quickly available, there still might be issues of differential access. I'm currently involved in a study of equity markets where the information from off exchange trades is processed in a somewhat different way than on exchange trades, and indeed proprietary data. The issues of proprietary data, even though the relevant time scales are in milliseconds, the issues of who purchases proprietary data and the pricing of that are still very important. It seems to me that's kind of a natural way to sort of motivate these issues, maybe even more so than the corporate bond market, although at least as much as the corporate bond market.
I think that's an excellent point. And in fact, I do think that the results here also refer to like equity markets, especially those that have kind of different kind of clearing mechanisms where trades are not very opaque. And there it's a really contentious issue of where we set the prices for market data access or the timeliness of this data. Now, I'm going to speak a little bit more on that later on when we consider the strategic platform. And I agree that to a large extent, we do have something to say also about how we should be thinking about the way in which platforms and exchanges are setting their prices for kind of the timely access to these data feeds. So, and that's a great segue to our final point of this talk, considering strategic platforms. So we're going to consider how a strategic platform may endogenously determine the information environment. And our kind of key result is that they're going to induce an information environment that maximizes the adverse selection in the market. And as a consequence of this, the platform is going to endogenously impact, push market liquidity to the lowest possible level that is obtained under the exogenous setting. Now,
Michael, just to understand that last result, what is the objective of the platform? To sell the information, or I guess you're not charging for trades based on what you just said.
So in this environment, and I'll go into more detail later, but the strategic platform is going to set the cost associated with buying the data to the dealers, and they're going to maximize their kind of conditional profits given how much that they're going to sell, how many of the dealers will buy the information, and also the cost of the information itself, which is going to be endogenously determined by how the strategic platform chooses its cost setting strategy. All right, so the intuition for this main result is actually quite simple. So the platform here maximizes profits by maximizing the value of information itself. It wants to sell valuable information, and it plays a part in how the value of this information is determined. In particular, value is maximized when being informed is most harmful in interdealer markets. So that's when you have the largest gap between being an informed and uninformed dealer in the market. Now, because of this, the platform induces a disclosure environment that achieves the worst liquidity outcome of all the exogenous information disclosure policies that we'll cover. And this shows you that in the process, the platform is able to extract the information rents obtained from trading activity.
Can I ask a question?
Yes.
Is there a reason for which you focus on the interdealer market? You could equally say we disclose information to everybody in the market or study questions around that. Why do you have this interdealer market plus the non-interdealer market?
I see. Well, that's going to be largely a kind of a result of the model structure that it might be a little bit clearer. In here, the dealers are kind of the main protagonists that are trading actively, both with respect to traders who are less active or clients of the dealers and dealers themselves who can now come with this kind of outside information and trade actively amongst themselves. So here, the kind of stage at which information will be most valuable is in this intermediate level where dealers are now differentially and asymmetrically informed, arrive together, match with each other, and have an opportunity to trade. All right, so there's a very large literature. I'm just going to go through it very quickly. So there's a large literature thinking about the impact of information and dealer intermediate markets, and also kind of the liquidity provision in decentralized markets. Now, we take into account kind of both in a world where dealer intermediate market, we have dealers intermediating markets facing kind of these informational issues, but also wanting to provide liquidity. And in particular, information asymmetries are going to naturally occur as they learn separately from their market making activity. Now, on top of that, we consider disclosure. And our main contribution here is to take one step further and consider what happens when we try to endogenize the disclosure environment by thinking about what the choices of a private platform will be. So kind of to address a lot of the questions, let me go right into the model and describe our environment. So we have 3 periods, time 1, 2, and 3, and we have 2 types of risk neutral agents. The first type of risk neutral agent is a measure of dealers indexed I. So we have many dealers, and we also have many traders here. So here the dealers are what we talked about, what I talked about in the introduction. The traders here represent the clients or periphery dealers that are less active in the market. Now, finally, we'll have a central platform who is going to provide some post-trade services. So the model has this tiered trading structure, and their trade occurring in 2 periods. So in the first stage is what we call the market making stage, where dealers or traders are randomly matched, and dealers make markets on behalf of traders. They make offers to a bid-ask offer to traders that traders can accept or reject. In the second stage, the dealers now turn around and trade with each other. And so they have a second opportunity to trade where they're randomly matched with each other, and dealers have equal probability of making an offer to each other in the interdealer market. So this is how we kind of capture this tiered trading structure, where in the first stage, dealers have this decentralized trading with their respective clients. And in the second stage, they turn around and they have an opportunity to trade amongst themselves, where they play a central role in the kind of the trading of this OTC market. Now, in this market, there's a single asset that's traded between agents. And the asset has some value V that's unknown to all initially. And it has a low, either in a low or a high state, where the value in the low state is V bar minus X, and in the high state is V bar plus X. So with equal probability, the value is high or low. And in particular, these traders that meet with these dealers have a dispersed private valuation. So traders' valuations are heterogeneous, and they're comprised of both the common value of the asset, V, and also kind of a private value. So here you can see that in the top bar, which represents the low state, the private valuations of traders ranges anywhere between V minus D to V plus D. And the high state, correspondingly, you have it from V bar plus X to minus D, V bar plus X plus D. So here, there are 2 components I want to highlight. X here represents the extent to which the value of the asset is uncertain. So here, the value of the larger the X is, the greater the dispersion in the true value of the asset across states. D here represents the private value of the traders, and this shows you that traders in general have these different motives for wanting to trade other than the value, but their private valuations are also correlated with the common value, which means that their trades are also partially informationally driven. Now, of course, in the market making stage, then each dealer is matched to one trader, and they make a bid-ask offer to the trader. So these are ultimatum offers, either at a price at which they're willing to buy or sell to the trader. So the average valuation here is V bar. This is the prior expected value of V. And a dealer will choose specifically a bid-ask spread delta I. So with the bid-ask spread delta I, this corresponds to an offer to buy an asset at V bar minus delta I, or an offer to sell an asset at V bar plus delta I. Now, if we think about a trader J with some valuation, the decision of whether to accept or reject an offer is very clear. If you have a very low valuation that's below the offer to buy, then you're willing to sell to the dealer. If you have a very high valuation, then you'd be willing to accept the sell offer by the dealer. Now, if your valuation is in neither category, then you would want to reject both the dealer's bid and the ask offer. So you can see here below, given a bid-ask spread of delta, the red shaded areas correspond to the set of traders that would be willing to accept a particular offer. You can see here, the lower line here is going to correspond to V bar minus delta, is the price at which the dealer is willing to buy an asset from the trader. And so traders with a low valuation are going to accept this. Oppositely, for the ask price is higher, and traders with a high valuation would accept that. So dealers from their market making activity are going to acquire a position either -1, 0, or 1. And we're going to refer to those that are
one question, Michael. So what assumptions are you making on the distribution of the private valuation? That is, the results are going to hold whatever the distribution, or you need some restrictions on the distribution?
Oh, I see. Okay.
For instance, the support, I guess you need a restriction on the support. And so D cannot be too low.
That's a great question. Actually, I failed to mention that the distribution here is a uniform distribution over D. So traders here have this private valuations that range from -D to D, and their preferences are assumed to be uniform over this distribution. So D here, the capital D, represents kind of the dispersion in private valuations.
And does it have to be kind of big enough so that no one wants to kind of experiment and get into one of these regions where you learn everything, or that's okay?
That's perfectly fine, and
Okay.
I'm actually going to cover those cases as well.
Okay.
But if D is very small compared to X, let's say 0, you cannot have any trading in this market.
Yes, so we have assumptions on D being sufficiently high such that trading can be substantiated. For example, if D is very low, then market making might be prohibitively costly for the dealers. All right.
So Michael, can you hear me?
Yeah.
So the V common value is observable to the traders or not? Do the traders know the common value of the asset? The client.
So here we're going to assume for simplicity that the traders only know their private valuations. It's
Okay.
correlated, or part of it is going to be this V
Correlated.
component, but they wouldn't know directly.
Another question is, the dealers, are they required to post a bid price of V-bar. The reason I'm asking this is by looking at this picture, it seems that if they shift their mid price, let's say to the right, and so that they shift both the ask and bid, they can potentially get a more precise posterior belief about the common value of the asset. So the extreme case is that you shift it all the way to the right so that it hits the boundary of V bar minus X plus D, so that if the guy actually buys, it has to be a high valuation person.
So that's a great point. And actually, you don't need to have an asymmetric bid-ask offer in order to achieve that. Increasing bid-ask spread here will necessarily increase your posterior in all states of the world. And in fact, the endogenous choice of where you choose delta is going to be a key component in the model as well. You want to also incorporate the choice of delta into how much information you actually want to obtain in the market making.
Yeah, for sure. Delta definitely matters. The larger delta is, the more precise information posterior you can get. But the problem with choosing a bigger delta is that it's costly. You're choosing a higher bid-ask spread in order to get more precise posterior, but fewer people are going to trade. So that's the advantage of choosing the mid price, because by choosing a mid price that's different from V bar, you're not necessarily lowering the expected volume that you can trade, but yet you get the more precise posterior.
I see. I now understand your question. So I would argue that our result is without loss of generality in terms of the equilibrium. Now, we don't take into account the potential asymmetries here, but as you'll see, with this kind of assumption, we're able to build much more on top of how their bid-ask spread relates to interdealer trading as well. So this is going to be a simplifying assumption. But in general, if we were to also relax it so that they could choose different prices, our equilibrium would still prevail. All right. So after all of this market making, each of these dealers inherit a position based on their market making activity, and we're going to call them long, neutral, or short, depending on the positions that they've acquired. And so in the interdealer trading stage, these dealers are now going to randomly match with each other. And as opposed to with the market making stage where dealers exerted market power, they were offering these ultimatum prices at which they're making markets, dealers will now have equal probability to make an offer to each other. So with random probability, one of them is the offering dealer, the other is a receiving dealer. And here they make an offer that has to tell them what the direction of the trade, whether it's buy or sell or no trade, and the transaction price, at what price they're willing to trade. Now, I haven't yet talked about kind of where the platform comes into play. So dealers here are members of a central platform. You can think of it as a CCP. And each dealer must report at date 1 and date 2 the trades that they do in the platform. And secondly, at the end of date 2, they contribute capital proportional to the net position. So the range of positions that dealers can have is anywhere between -2 to 2. They have 2 trading stages. They can either buy twice or sell twice. And as a result, it ranges from -2 to 2. And dealers here incur a cost delta that's proportional to their net position. So delta here represents kind of the liquidity, the cost of liquidity associated with making markets and accumulating a large liquidity position. You can think of this potentially as the servicing costs, the inventory costs, or even kind of the regulatory costs associated with managing a large net position, either negative or positive. So here the platform is able to collect the information on this decentralized market making activity. In particular, they're able to, from the reported trades, observe the set of trades that occurred between the traders and dealers at date 1. And this is going to be kind of the main source of information that the platform, we're going to consider the platform disclosing back to the dealers.
Michael, one question, is it a choice to report information to the platform?
It's not going to be a choice. We're going to assume that this information is provided, and we're going to instead consider how this information may be aggregated and redisseminated to the dealers.
And on that, you mean the report has to be truthful?
Yes, that's right.
And just to see if the platform was to report the net flow, the net aggregate flow after the first stage, that will perfectly reveal the value of the asset, the common value of the asset, no?
That's right. So the aggregated data is going to reveal actually perfect information on the underlying value of the asset. If you were able to observe a mass of trades, this is going to be very valuable in terms of inferring the true value of the asset.
But then if you do that, you destroy any gains from trade in the second part, no? Because
that's not going to be the case, actually. And this is precisely because ending the 2 periods of trading with a net position that's non-zero is going to be costly. So let me, actually, I'm going to go through this in a few slides if you let me go through how interdealer trading occurs and why gains from trade exist in this particular environment. So just to kind of recap here, we have at time 1, dealers making markets for traders. They also then submit these trades to the platform. At time 2, dealers then trade with each other. And so after these bilateral trades between dealers, these trades are submitted to the platform. Dealers are going to incur a liquidity cost associated with their net position. Now, in the final stage, the platform settles the positions, it returns the capital, payoffs are realized. So here we have the solution concept is perfect Bayesian. Dealers are maximizing their expected profits. This means that they're choosing their market making strategy. They're choosing their interdealer trading strategy, which includes the offer strategy when they're an offering dealer and the acceptance strategy when they're a receiving dealer. Now, traders here are maximizing their expected payoffs given their private valuations. It's very simple, and I've already covered that. And we're going to focus on symmetric strategies where dealers are going to be choosing the same market making strategies in equilibrium and also choosing interdealer offer strategies that are identical between types, which is to say long, short, and neutral dealers are going to choose symmetric strategies in equilibrium. So I'm going to start with no disclosure, show you the mechanics of the model, and then I'm going to progressively increase, kind of generalize the environment to consider various disclosure environments. So in the baseline case, we have no public post-trade disclosure, and we're then going to put on top information disclosure and the strategic sale of information. So let's start with the interdealer markets, working backwards. And so let's suppose that all the dealers chose some market making strategy delta I in the market making stage that's identical. So they all chose some identical market making strategy. And so we have a set of long, short, and neutral dealers, depending on the types of traders that they matched with. So what happens? Well, in the interdealer market, all of these dealers are still privately informed based on their market making activity and also don't observe their counterparty's type. So when a dealer matches with another dealer, they don't know what types of activities they had gone through. They need to make an offer based on an anonymous identity of a dealer. So let's consider kind of what the ideal interdealer offer strategy might be. So let's focus on a long dealer. And let's suppose that the long dealer chooses to make an offer to sell the asset at some price P. Now, this is quite a reasonable offer. And the reason is because a long dealer has just purchased an asset from a trader. And if it's able to offset this position by selling the asset, it effectively is able to avoid this liquidity cost delta. So by ending the 2 trading periods with a net zero position, now we can economize on liquidity, avoid this liquidity cost. So suppose that the receiving dealers here also infer that these types of sell offers are made by a long dealer. Now, this is also quite reasonable. They also understand that the long dealer wants to offset its position. And in this particular case, that means that these long dealers are separating from these other types of dealers by signaling through their offer. In other words, even though you don't know the identity of the dealer, through its offer, you can infer, okay, it's a long dealer. He wants to offset his position by selling the asset. Now, then the question—
Can I just ask a quick question? It might be a dumb question. Just understand the delta liquidity cost. So that's exogenous and symmetric. But if I end up learning after, I guess, T equals 1, that the asset is higher quality or whatever than I thought it was, that doesn't affect this perceived liquidity cost of, it's still just as costly to be long versus short, even though now my beliefs about the quality of the asset have changed. Are the beliefs just going to factor into what I do in the interdealer market? Is that where it's going to come in?
So that's correct in the sense that the liquidity costs are completely orthogonal to kind of the value of V. Yeah.
Okay.
Yeah, but that's, I think that's an important, that's important for the interpretation, because the one line of modeling of inventory cost in the literature is to say they are proportional to volatility because people are risk averse, dealers are risk averse. And of course, you know, if you suppress any uncertainty about V after disclosing information, then that cannot be a motivation for trading anymore, which was the sense of my first question. If the liquidity cost was proportional to the uncertainty about the payoff of the asset, the common value, then it will depend on how much information people get about the common value after the first stage of trading. So it's quite important. The way you specify the liquidity cost or the inventory cost, it's important that it does not depend on any remaining uncertainty about V, I guess.
So that's true that delta can potentially be a function of the fundamentals. Having said that, even when it's completely orthogonal, the kind of your beliefs about V is definitely going to also be incorporated into the offer price that you make and the potential for the receiving dealers to accept the offer. So even though we have two different components, how much information you know about the value is going to determine, you know, what types of prices at which you're willing to trade in interdealer markets. And there you're weighing between the kind of the liquidity costs associated with accruing a larger position versus kind of the belief about what the value of the asset is.
No, I fully agree with that. It's just, my remark was just about the connection with another strand of the literature where it's important that inventory holding costs are proportional to sort of remaining uncertainty.
Yeah.
Here so it's just, the question is, what is the interpretation of this liquidity cost exactly? And here it's sort of important that it's orthogonal to remaining uncertainty. That does not mean that you cannot assume such a cost. I think there are costs like that. It's just that it's sort of a different way to model inventory holding cost, I think.
What I'd like to note also, though, is here, you know, in the end, an individual dealer does not necessarily know the underlying state of the world. So they may have some beliefs regarding V, and accordingly, the liquidity cost might be greater if they anticipate that the inventory is more costly to kind of manage in the future. Let me kind of go into kind of the interdealer offering strategy, and that may also clear up a little bit about thinking how we're thinking about how it factors into interdealer trading.
Hi, Michael. A very quick note about Thierry's question is maybe there is a way to say that the prior of the signal, to change the signal structure so that the prior is like some Gaussian, and then the posterior is still a Gaussian with the same variance, in the sense that after trading with a client, I learned that the expected value of the asset is higher, but that's the only thing I learned. I'm not reducing the variance of the belief, so that will keep the liquidity cost constant and be consistent with the inventory cost being proportional to the volatility view.
That's a good point. I'll have to think about that, but yes, I think there could be micro foundations that we could build in to kind of further justify this. So let's think about this environment where we've kind of conjectured that a long dealer makes these sell offers and only long dealer makes these sell offers. And we still need to think about the price at which the long dealer is willing to set or make this offer. Now, there are three candidate prices that we can think about depending on kind of the mass or the types of dealers that the long dealer wants to kind of encourage to trade, accept the trade. And we need to think about then the reservation price of these various different types of receiving dealers. So if we break down kind of the reservation price, it's a matter of first the kind of the fair value of the asset conditional on being matched, a match being happening between a long dealer and a dealer of type theta. And then plus, and this is the important part, kind of the resulting liquidity positions of the receiving dealer. So what we can see here is that gains from trade only arise when both dealers are offsetting positions. So when you're a short dealer, you receive an offer by the long dealer. You like this trade because you can also lower your net position. And as a result, your reservation price is going to rise by delta. But for these other types of dealers, it's really just a transfer of these liquidity costs to their balance sheet. And this means that they actually require an additional delta premium associated with at the price in order to be compensated for taking on a larger position. So this implies that actually the long dealer wants to make an offer that's equal to the short dealer's reservation price. Also notice that even in the first component here, and the conditional expected value of V, the short dealer has the largest difference in beliefs with the long dealer. They are differentially informed, but together they have the most different views. And this means that even the first component is the largest for the short dealer. So altogether, what this implies is that interdealer trading in this particular setting happens primarily between these long and short dealers who have opposite positions. So endogenously, they're going to choose to make offers and receive offers that correspond to those that would be only accepted by those of the opposite position. So as long as there's a positive mass of long and short dealers concurrently in the market, then interdealer trading occurs between these long-short dealer matches. And these are also precisely all the trades with surplus. So even though we consider the potential for them to be differentially informed, it ends up being that it's optimal for them to make the offers such that the desirable types of interdealer trades occur. Now, there's a separate question of what happens when the dealers choose a large bid-ask spread. And when delta is very, very high, then consequently, long and short dealers don't coexist in the interdealer market. Now, the one way to see this is the following. When the bid-ask spread is sufficiently high, the traders in the market are only accepting trades on one side of the market, and they have to have very extreme valuations. As a result, there is no interdealer trading that can occur. And so you can see that interdealer trading is going to also hinge on kind of the extent to which dealers are willing to provide liquidity to their traders, and also then to actively trade and participate in the interdealer market. So as you can see here, in this particular environment, we have this feedback between market liquidity and interdealer liquidity. So when dealer liquidity provision rises, when they choose a smaller delta, that means that there are more dealers on both sides of the market. And with more dealers, there's more opportunities to have these offsetting trades between dealers. This allows for dealers to save liquidity by lowering their net position, and this improves the benefits of liquidity provision in the market making stage as well. And so as a result, there's this positive feedback between market liquidity and interdealer liquidity. Now, the real question then is, do dealers really choose the optimal market making strategy in equilibrium? And so with the baseline case of no public post-trade disclosure, without this external disclosure, all of the individual dealers' information is solely determined by their market making activity. Now, if we think about the bid-ask spread here, of course, the bid-ask spread is going to determine the profits conditional on trade and also the likelihood that the trader accepts an offer. But it's also focal to determining the beliefs of the dealers conditional on a trader accepting an offer.
Wait, so I'm confused by one thing, sorry. There's uniform, you have this uniform distribution. So I would have thought then that until you get into the region where you learn everything, you actually just learn nothing because of the uniform. Is that not right?
That's actually, the way to kind of visualize it is this particular figure. So what happens when you increase your bid-ask spread? Well, you are able to gain more precise beliefs about V. And the exact thing that you should be looking at is the upper bar on the left side versus the lower bar on the left side. The ratio between that is going to determine your posterior beliefs.
Oh, I see. Okay, I got it.
The uniform distribution lets us have a really kind of clear characterization of how your bid-ask spread directly relates to how precise your beliefs are. And you can see that as delta shoves to the end, at some point you're going to have perfect information regarding the value of the asset.
I see. Okay, so then when you go back to that picture you had of the feedback, you're basically saying delta small, they don't learn much. There's not as much adverse selection in the interdealer market. So delta small, you're calling that high liquidity. They don't learn much, not much adverse selection, and then more trade in the interdealer market. That's the circle here. Is that right?
Well, so with one caveat here. So when delta is small, there are more dealers on both sides of the market. So if you consider, for example, the picture here, the top bar is the state where the value of the asset is low, and the red bars on the left and the right correspond to the short and the long dealers in the market. So when we have more of on both sides, there are more dealers that can kind of take advantage of interdealer trading that can conserve on liquidity. Now, as I showed before, even though they're differentially informed, the information problem is not an issue here as long as they conditional on delta. So fixing delta, the information problem doesn't exist because they end up opting to choose the types of offers that will lead to trades between long and short dealers. So the issue is not how the adverse selection when they're differentially informed. The issue here is what delta will they choose in equilibrium? And that's when the information problem and the potential concerns about adverse selection factor in.
But Micheal, there is something I don't get here, which is in the interdealer market, there is going to be an imbalance between the number of long dealers and the number of short dealers. For instance, in the example that you just give here, you are going to have more dealers with a long position than dealers with a short position. So that means that there are some dealers who would like to buy, who would like to sell, who are not going to receive any offer. And so
that's correct.
People are not receiving an offer. That should tell me that I am on the bad side of the market. So that's already a source of information. That is the fact that I receive or not an offer tells me something about the direction of the imbalance.
That in the interdealer market, that's correct. But there are only two trading stages, which means that you exit the market at that point with whatever net position that you've ended up with. So,
but then, just to push you on that, conditional on getting an offer, that gives me no information.
Conditional on getting an offer, you will get, your beliefs will definitely change. So let's to be more precise, let's suppose that all the dealers chose a market making strategy of delta. Suppose you're a long dealer, so you've just acquired an asset from the trader. That means that your posterior beliefs shift such that you think now, okay, well, someone was willing to sell the asset at my price. That means that maybe the value of the asset is low. Now your values are skewed, so that's low. When you meet a short dealer, they've just sold an asset to a trader. So they have the opposite beliefs entering the interdealer market. So conditional on choosing the same delta, this means that when you two match, the long dealer and the short dealer matches, then the conditional expected value of the asset, given that a long and a short dealer matched, is exactly equal to V bar. You cancel each other's information and both of your expected values is going to be equal to each other. So yes, that it gets incorporated into the price, the reservation price conditional on trading as well, which we've kind of covered in the interdealer trading strategy.
Michael, just a reminder, I have 10 minutes left.
Okay, so we've spent a lot of time. I want to kind of get to the core results. So let me kind of zoom through this. And so basically, there are two factors here that kind of are suboptimal. First of all, we have many dealers, they're not internalizing the value of interdealer liquidity. And second of all, the information acquisition problem dealers can acquire more information privately using wider bid-ask spread and become more informed in interdealer markets. And this is going to really be the push that drags the bid-ask spread higher and determine the equilibrium bid-ask spread chosen by the dealers. So in particular, if we break down the marginal interdealer payoff from choosing a larger bid-ask spread, the first component here is the gains from netting, but the second component arises with information rents. If you choose a wider bid-ask spread and you acquire a position that puts you in an advantage in interdealer markets, you're able to extract some information rents correspondingly. So as a result, in equilibrium, we have that we characterize the conditions under which we have equilibrium interdealer trading. Now, the issue here is the fact that relative to the social optimum or the social planner solution, the bid-ask spread is too large. They're not internalizing these benefits from having more interdealer trading and also providing this liquidity to these traders. And so we have suboptimal liquidity provisions, too little interdealer trading activity, and also interdealer trading can inefficiently break down as well. Now, in the interest of time, I'm going to kind of skip over this other equilibrium that exists where interdealer trading can break down. But for when the uncertainty regarding the value of the asset is sufficiently large, we have this other equilibrium where interdealer trading doesn't exist. All the dealers act as essentially make markets in an autarky and are offering very large bid-ask spreads to the traders, kind of exercising their full market power on the traders. All right, so let's move on to the exogenous post-trade disclosure environment. Now, what I've kind of shown you here is that there's these private gains from information that stunts and it can even break down interdealer trading. And so a natural question is, how can we use disclosure of this post-trade information to maybe improve liquidity and efficiency in these markets? So as I kind of alluded to earlier, the platform here can gather all these trades. And let's consider the case where they publicly disclose all the sets of anonymous trades that have occurred in period 1. So all these traders, these dealers have made their markets, they submit their trades, and now they can observe kind of the volume of trades that are happening in the market. Well, given our market, our model, with this kind of full disclosure where all dealers become equal, informed about these trades, they can also perfectly infer the value of V. And it's because we have a measure of trades, so that's enough information for them to know exactly what the value of V is, whether it's high or low. Now, what this means is that when you enter the interdealer market, all the dealers know the true value of V, and so all the prices have to reflect the true value of V. So instead of having this kind of conditional expected value of V, the prices are pegged on V, and then the residual parts where the gains from trade arise, and so you have V plus minus delta as the offering trades in this interdealer market. So as a result, here we can see that learning from the market making stage is not really profitable. You can choose a larger bid-ask spread, but you expect that everyone will be perfectly informed and equally informed in the interdealer stage. And so doing so would be to would serve no purpose. And so this destroys the private incentives to acquire more information by using a larger bid-ask spread. What that means is that when we go back to the marginal interdealer payoff, those information rents that you could acquire from choosing a larger bid-ask spread relative to your peers is now destroyed. And as a result, we have that in equilibrium, equilibrium spreads go down. Dealers are committing to a smaller bid-ask spread, and also interdealer trading is more sustainable for even larger values of X. Now, I kind of talked about in the introduction the potential for limited disclosure. In particular, what happens if information doesn't reach all dealers? Now, this could be because even if post-trade information is publicly available, not all dealers may be able to incorporate this information in time for subsequent trades. Or it could also be because of selective disclosure to a subset of the dealers. Now, whatever the case, in order to kind of answer this question, we need to kind of think about a generalized environment. So let's consider a world where a random fraction lambda of the dealers are accessing the information instead of everyone. And I'm going to refer to those that obtain this information as informed, those that don't as uninformed. So in this particular case, now we're going to nest the two cases. With no disclosure, that just means that no one obtained this information, and we have the lambda equals 0. And at the other end of the spectrum, we have perfect disclosure or full disclosure where lambda is equal to 1. Now, we're going to further assume that the identities of the dealers are who become informed are unknown. So now we have a larger variety of dealers that are entering the interdealer market. Not only do they have a particular position going into the interdealer market, but they also might become more informed than others. Now, this kind of limited disclosure adds another complication to the environment because now some dealers have the superior information. So I've often referred to the information before as differentially informed. Dealers have different types of information, and so they're asymmetrically informed, but no one has more superior information in equilibrium, given that they all have similar market making strategies. But now with post-trade disclosure and the access to it, some dealers can be perfectly informed. And as a result, we show that dealers are sometimes going to reject trades that would offset their positions. Now, this happens in various different ways. So to kind of understand this, let's consider the case where lambda is very
Michael,
small.
can I ask you something based on what you just said?
Mm-hmm.
So I thought that before, even though we have the same strategies, in the no disclosure case, you know, some of us might get rejected and some of us might not, and that might give us differential information. That's not the case. Like if I get someone that it's in an extreme and they reject, that might give me more information. I guess you're not saying that I'm better informed, but so there are no situations in which my posterior is more precise than the other one based on the rejection that
from the market making. Are you referring to from the market making stage?
Yes.
Yeah. So when no one accepts a trade, you may be differentially informed. So you're in that case, you're a neutral dealer. In that case, actually, you don't update your beliefs because you haven't gained any information from a trade. When you take a position based on the trade, that's when your posterior shifts, either positive or negative, depending on the direction of the trade. So they are differentially informed. In fact, you're right. Neutral dealers are less informed, but they also don't participate in interdealer markets either. Yeah. All right. So I want to get through the platform. So I'm going to skip through this actually and kind of just discuss the results. So essentially, we characterize two types of different equilibria over the span of lambda. For lower values of lambda, dealers trade at what I call pooling prices. And pooling prices in the sense that informed dealers are pooling with uninformed dealers and extracting information rents. Now, for larger values of lambda, when more dealers become informed, dealers start to trade at screening prices. So informed dealers trade as if other informed dealers are the receiving dealers. So they trade at the true price of the value of the asset. And in contrast, uninformed dealers are scared about being scalped by uninformed dealers, and they use very extreme prices to screen. And that ensures that while they reject a lot of trades, and they also their offers are only accepted sometimes, they aren't scalped by informed dealers. Now, kind of our main result here is the fact that actually, as long as X is sufficiently large, as long as there's sufficiently strong motives to trade for informational reasons, market liquidity and dealer payoffs are both non-monotonic over the interval of lambda. So what I mean by this is that over lambda starting from zero, as we gradually increase the fraction of dealers that become informed, overall market liquidity actually goes down. Now, because of this non-monotonicity, this means that for limit disclosure in the intermediate values of lambda, we have that market liquidity and also overall market efficiency is worse relative to no disclosure at all. So while we understand that full disclosure leads to better outcomes, having this kind of limited rollout to the dealers can actually harm the market liquidity. Now, this is an important result because now—
Michael, just so I understand the exercise here, when the dealers at stage one are choosing actions, do they not know whether they're going to be informed or not?
They don't know whether they're going to be informed or not. That's
I
correct.
see. So it's like you do this and then you randomly get the information or not.
Exactly.
Because otherwise you might get the result that you just push out the guys who aren't going to be informed, and then there's no adverse selection at the second stage, right? It's like if I haven't bought the subscription, I can't play. As adverse selection is too extreme, I wouldn't play anymore.
That's right. And in this particular case, the only thing that we gain from here is that we don't need to think about different market making strategies by different dealers. So all of the dealers still choose the same market making strategy, anticipating that with some.
No, I understand why it's easier. My question was just about the interpretation of it.
Now that's going to not matter when we go into the next stage, when we endogenize the information acquisition. But that's correct. In this particular case, I think a good way of interpreting it is that they anticipate that with some probability, they won't be able to participate in interdealer markets using that information. And this probability is uniform across all the dealers.
Michael, would you like to conclude and then we can open the discussion?
Sure. So let me just skip to kind of the punchline here. We consider with this a platform that's going to choose a set of costs to set the prices according to the price that the dealers can acquire this information. Now, there are two options that the platform can really choose from. If the platform chooses the costs to be sufficiently low, then naturally all the dealers will choose to acquire information. And so endogenously we'll have lambda equal 1. Alternatively, the platform can set C to maximize the value of information. And with this, you can also, by doing so, you can increase the adverse selection into the interdealer market with these intermediate values of lambda. This also corresponds to the world where you can charge the highest cost. And we show exactly this, that the strategic platform will choose a cost structure that induces this intermediate lambda that maximizes adverse selection. So now here, I just want to emphasize the strategic platform here diminishes liquidity in two ways. First of all, is a really straightforward reason. They're charging costs for information. This taxes dealers' market-making activity, and this is going to widen equilibrium bid-ask spread. But secondly, more interestingly, they're going to set the costs high enough to ensure that only a subset of the dealers are acquiring information. Now, what this does is essentially they're setting the cost of information equal to the informed dealer's information rents. If you buy information, you can use that strategically in interdealer markets to extract rents. Well, the cost is going to be set exactly equal to that. And by doing so, the platform is able to extract the entirety of the expected information rents that arise from interdealer trading. Now, this is particularly relevant because the implementation is really simple. You just need to set the costs sufficiently high, and this ensures that only a subset of the dealers will opt to acquire this information in a way that also substantiates the information rents, and doing so allows for the platform to effectively extract all of the rents associated with the superior information that occurs in the interdealer market. So there are various cases.
If the platform could also charge people for trading on the platform, especially the people in the first stage, the clients, then there might be a trade-off, because you don't want the clients to pay a too large bid-ask spread. So I get, when you think about the pricing of data, I think it's important as well to think about the pricing of order flow, because the two are chosen jointly typically by platforms. And so here, I think the assumption is that you cannot charge for the order flow, so you just charge for data.
So more precisely, so I skimmed over the exact extension. The pricing strategy of the strategic platform is decided in the intermediate period. So if the platform can commit to a particular price, ex ante, and over time, then they might want to lower the prices in order to ensure that they don't destroy the liquidity provisions of the dealers. If, however, the platform can anytime deviate to a larger cost after the dealer market making stage, then you're going to see that the platform is always going to choose the exact cost structure that I've described. So in this way, even if they could charge different costs associated with that, as long as they don't have the commitment ability to a particular type of cost structure, then this outcome will be realized. All right, so I'm out of time. Kind of the main takeaway here is that when we consider a world where information is endogenously determined by a strategic platform that controls post-trade data, they have this incentive to maximize the value of information and induce an information environment that achieves the lowest possible liquidity. In particular, they're able to indirectly extract all the information rents generated from trading activity. And this kind of highlights one of the a core kind of policy issue that we're facing today as platforms are choosing to increase market fees and also induce differential access to the market data that can be used to improve coordination and also liquidity in the markets. Well, thank you for all the questions, and I look forward to the following discussion.
Thank you. Then we're open now for more discussion.
Can I ask a follow-up question on the last question? Thinking about what is the objective of the platform. So have you thought, even in, I mean, maybe for this some commitment is needed, but which is something you mentioned, but have you thought what would happen if platforms are competing for trades or for info?
So that's a good question. We take as given that we have some kind of centralized platform that has this special access to this information. And so naturally then the question becomes, well, you know, should we have more competition between post-trade platforms? And, you know, that brings a different type of conflict in my view, because they're centralized for a reason. There are these huge network effects once we allow for example, clearing to occur on a single platform. And so then the question is less about you know, we like the centralization in that respect, but how can we substitute for the competition that naturally would maybe bring those prices down, allow for, you know, more ready access to this information to all the market participants. Now, my conjecture would be that with more competition, it could come down unless we have some kind of collusive environment where they're kind of coordinating on the pricing.
Michael, can I just make two quick comments? I have to run in a second, but first of all, just a comment, like, I thought the intro was a little weird. Like the focus on sort of centralized platform versus OTC markets, I think took not just me, but judging from some of the other comments too, you go in a bunch of different directions. I mean, this is really just a paper about post-trade price transparency, right? I mean, whether the exchange is centralized, decentralized, stuff like that, as long as prices are being published immediately, that's kind of what you guys are after. Or maybe I'm wrong, but there were a bunch of questions on the side. I mean, I was talking with Anton a little bit like about pre-trade price transparency. You could think about whether there are frictions or not frictions in matching, right? Because centralized platforms maybe match people better or not. But your paper has nothing to do with that. It's really just about the post-trade price, I can't say that, post-trade price transparency. So I thought maybe focusing that a little bit sharper in the intro might have avoided some of the, at least my confusion. I'm not a representative agent usually, but then the other thing I wanted to mention is like, I think it's important to highlight that you had to go kind of fast through this part at the end, but a lot of the sort of, I understood after the fact that a lot of these efficiency gains with having a smaller delta come from this kind of artifact of the model, right? With bilateral trade, you maximize the number of trades when you have half buyers, half sellers. But again, it's just sort of like, that just comes out of the model, right? I mean, there's not an obvious reason why if people could trade with more than one person that you necessarily have that result. So I would have made that a little bit more clear. There might be other reasons in other models why trade imbalance is bad if you have a lot of buyers and few sellers, vice versa. But here it comes from this like old Kiyotaki Wright style result that the way to make the most trades is to have half buyers and half sellers with bilateral transactions. So I don't know if that makes any sense.
Well, regarding the second point, you know, here we assume kind of maybe the simplest version of just random matching and bilateral trades, this could easily be extended so that they have multiple traders. I mean, the number of matches is really less relevant. Now we could consider a completely different type of.
But it's let me stop. It's driving a lot of the results here, right? Because with some of those welfare results depend a lot on the fact that if you have a bunch of people trying to sell and only a few people able to buy, that's really bad in this environment, precisely because you have very few matches. You end up with a lot of people on the long side of the market who can't trade. Whereas if you had a centralized market, the price would adjust and you could clear, right?
That's not necessarily the case in the sense that, all of the matching happens. So there wouldn't be a price at which, I mean, the issue here is that the gains from trade are coming from kind of reallocating the assets so that the dealers as a whole can lower their liquidity positions, less so about there being a price at which they're willing to transact. Because in the end, even if you were to trade with a neutral dealer who came in with a net zero position and you could find the trade, it definitely could find a price at which that transaction could take place, the neutral dealer is going to there's no gains from trade from there. You have the same information when you trade in equilibrium. And so really it is really about the imbalance and to make sure that at the cost of not acquiring more information in the market making stage, that the dealers are now able to reallocate more of the assets from one side of the traders to another. So in that sense, it's really not about whether, there are different types of matches that want to trade together. That's exactly kind of the first point that I showed with how the way the interdealer market works. All the trades that we would want them to happen is always happening. The question is whether they can commit and choose a lower bid-ask spread that allows them to kind of internalize the benefits of not trying to be better informed in the interdealer market.
So you're saying that the second you assume that there's this sort of exogenous cost delta, then whatever reallocation is going to happen, any sort of imbalance on aggregate is going to be that imbalance times delta, basically.
Yeah.
And I see.
Yeah, I mean, they can choose different strategies. They're just choosing not to because there's really no benefit of that. Like when I trade with a different type of dealer and we all have the same information. In equilibrium we have the same valuation of the asset. There's really no gains from trade anyway. I might as well just hold on to my position. Now, that's why the market making activity is important because we all have this individual incentive to deviate to a larger market making spread to have an advantage in this market. And so in that way, disclosure can potentially help because that kind of incentive is kind of destroyed.
Okay.
Can I ask the questions? I wonder whether your results can speak to the design of the ownership of this platform, like a CCP. So one thing that if I'm not mistaken, I think the dealers are really screwed over by this monopoly platform. So what they would have liked to do is to set up a different platform that basically owned by them, like a member-owned platform, and they mainly serve to provide liquidity to the dealers, producing information or basically providing information at a lower cost and to promote liquidity. So I think your result, if I take your results on face value, I think we should expect a more member-owned kind of platform to provide service to the members rather than a for-profit platform that screw over everyone.
I fully agree that, I mean, it's a relevant point, especially when we think about it. And I think that's, and we allude to this a little bit in the actual paper, with respect to kind of some of the innovations in terms of kind of decentralized platforms. I do think that that's one area where there's a benefit because dealers here then can collectively ex ante decide on a particular type of flow of data feeds and kind of make sure that that's in line with kind of their collective liquidity, liquidity provisions in the market making stage as well. Now one of the things that I kind of hinted at was this lack of commitment that these platforms might have. Over time, they would want to definitely raise these prices, even though it may in the long run harm the liquidity and overall trading activity in the particular market as well. So in that sense, that kind of decentralized platform where you need to have, for example, a majority vote in order to set the terms for the access to information can be quite valuable.
Hi, Michael. I wanted to ask a question about the commitment of the platform. Sorry, I have to mute.
Sorry, I'm going to first end the official recording, but you are welcome to stay and we can keep discussing. Okay. Thank you.
Thank you, Brianna. So yeah, I wanted to come back to